Podcast. I'm your host, Mehdi Farouk, Senior Tokenomics Analyst at Animoca Brands. On the other side of the mic, we have a special guest today, Richard Chen, who is a general partner at One Confirmation and a top Dune visit. Welcome, Richard.
Thanks for having me on.
So Richard, first question I want to explore with you is with regards to your crypto origin story. So how did you get into crypto?
Yeah, this was around 2015 when I was studying, doing research in cryptography, game theory, mechanism design in Dan Bonnet's lab. And that's how I first learned about like what Bitcoin, Ethereum, cryptocurrencies were, because that was kind of the natural use case of cryptography. And so I got into it more from the technical side, got super deep into the rabbit hole, co-founded the Stanford Blockchain Club, and really just went full time in crypto from there.
And what was the motivation to become a crypto investor at One Confirmation? We'll also love to explore with you what's your thesis there and how do you kind of evaluate investment and investment strategy there as well?
Yeah, I mean, as the difference between investor and operator, as an investor, you take like kind of a 30,000 foot overview of the entire space, and you gotta like understand, DeFi, AMM bonding curves like super well, just as well as you understand like generative art. So I like learning about a lot of different topics versus being a founder where you just got to be hyper focused and like the world's expert on like something very specific. So which is why I wanted to go into investing.
And at One Confirmation, how do you guys evaluate investment? What's the investment thesis, investment strategy like?
Yeah, so maybe some backstory. So we really started as like one of the first crypto venture funds. Kind of all the funds that preceded us were hedge funds that were more interested in like trading crypto, like having big like liquid portfolios, like doing rebalancing. But we want to take like a long-term VC approach of like backing founders and startups, working with them for like 5-10 years, and just being like the first money in and first partner in. So in terms of thesis, kind of like one overarching thing for the team is like authenticity. Is like, does this team really care about the crypto ethos that like decentralization matters, or are they here because like they're greedy and like want to make money? And like filtering out like authentic founders has like avoided us a lot of grief with like folks like Sam Bankman-Fried and those who like, yes, do really well in a bull market, but like the vibes are off. There's like always something that's like not quite right there when they're focused on the money rather than the crypto ethos, the ideals of decentralization, and bringing power back from like institutions to the hands of the people. So like that's kind of our first filter for founders. And then in terms of product, I mean, we're a generalist fund. Like we don't focus on just NFTs or only DeFi or things like that. It's really like new products that are pushing the space forward. So, back in 2019, a lot of that was like new DeFi protocols. Like that was where the building blocks of DeFi, like lending, borrowing, DEXs, insurance, those were being built. And then you had like this big NFT wave where like there's a lot of new verticalized marketplaces, and like that became super interesting. So we really just want to stay on the bleeding edge of like what are new interesting products for the crypto space. So yeah, I say those two, just like team and product market.
Yeah, whilst I was doing background research, I learned you guys were also seed investor, like very early investor in OpenSea. Uh, so I also want to explore that with you. Like, how did you spot that even during that time NFT wasn't wasn't as popular? So what was the different about that team, and like what was the thesis there, and how was the team different?
Yeah, so we invested in this. We led the seed round of OpenSea. This is April 2018. So OpenSea just come out of YC. I knew one of the co-founders, Alex Atala, from college, um, and this was around the time that CryptoKitties was popular. And there were two projects at the time, like building like secondary marketplace for NFTs, which were OpenSea and Rarebits. So, the Rarebits team was like a lot more polished. They were ex Zynga Farmville founders. They raised a lot more money from VCs. They had a good resume. But what I liked about the OpenSea founders, Devin and Alex, is they were just a lot more scrappy and nimble. Is like they lived in discords, were like very quick to like reach out to new NFT projects, and just understood like the crypto community, the NFT community way better, and basically like out executed Rarebits. So around the time we invested, they were doing about like 4 times more volume than Rarebits. Eventually, Rarebits shut down like around early 2020, and OpenSea grew to the business where it is today.
From a forward-looking perspective, I read your Substack a few days ago with regards to some of the product trends you're seeing
Yeah, I
going
always do that
forward in
every year.
2023. Um,
Yeah.
so just taking a slightly longer time frame, maybe like starting from short run to maybe long run, what are some of the themes and verticals you're bullish on or you think would do well?
Yeah, so my Substack, I do this like every year. I've done it since 2019, where I give like 3 predictions for the upcoming year and also like recap how I did on my predictions for the previous year. So for 2023, my 3 were ENS, MEV as a new business model for apps and wallets, and the third is generative art. So I can go over those pretty briefly. ENS, it's quite surprising that like everyone in like NFTs like talks about like PFPs, art, music, but like no one really talks about ENS. And it's like kind of the big elephant in the room because it has like there are about like 600,000 unique addresses that hold ENS. And like the second place is like 100,000. So it's like by far the most widely distributed NFT project. And it's also the 10th most called smart contract on Ethereum, which is pretty crazy. It's like the contracts that are called more are like Uniswap, OpenSea, Tether, USDC, like kind of these big OG smart contracts. And then it's like ENS. So it's like the adoption is like crazy, but like no one really talks about it. And if you look at the KPIs, they're also like growing very well. So that's one I'm really bullish on. MEV as a new business model. Just like a lot of money is like kind of well, not being left on the table, but it's going to like arbitrage bots and like sophisticated traders at the expense of LPs and like users. And if only there were a way for dApps to like capture the like arb profits, is like, and like one way to do it is like if you're on your app specific chain or rollup, you can like charge a fee for bots to do arbitrage, and then the fee you charge becomes either revenue for the dApp or it goes back to like the LPs of the protocol. That's like also like one good solution to like offsetting impermanent loss. I think that will become a more like common business model over like the next few years. Is like how do protocols make money without like charging fees to user? Like one way is just to like charge the fee instead to the art bots who are like really taking all this money like very pretty risk free. And then the third prediction I had was about generative art, and this is more in the context of like PFPs, because like a lot of PFP projects collections like prices are down, and like they want to add utility for holders, and like the way they're doing it is like by like creating like physical merchandise, building like a metaverse game, stuff like that, which in my opinion is like the wrong approach to take because unless like your company is really good at product and execution, to date most PFP projects have been good at marketing and brand, which are like two very different skill sets. And I think the right approach to take is like becoming art and a store of value. And generative art is a good example of that. You can say like CryptoPunks, while it is a PFP, I'd say it's more PFP than generative art. You can argue that kind of the approach, the direction they're taking is like becoming more of like a Grail brand, like exclusive generative art that's like intertwined with Ethereum's culture and history. And I think that's like the right approach to take for PFP projects rather than having like kind of physical real world dependencies to like the project's collections. So those were my 3 predictions for the upcoming year.
And how, as a fund, or maybe perhaps individually, how are you playing those 3 themes in terms of at the fund level or individual level?
Yeah, I mean, we made investment in ENS Vision for like the first category, like kind of largely based on that thesis. MEV stuff, there's a lot of interesting projects. We invested in Blockstrat back in 2018. That's kind of our only exposure to MEV. and then generative art. We also have an NFT fund, which like buys JPEGs. So we have like our main fund, which is investing in like equity tokens, like companies, and then the separate NFT fund that buys JPEGs. And that fund owns, CryptoPunks, nouns, some like art blocks, generative art, things like that.
Interesting. I also wanted to like pick your brains with regards to some of the themes that I'm also finding interesting recently. One is the NFT financialization that we are seeing. Another
Mm-hmm.
one is Web3 social and the whole reputation and identity layer being built up. So, what are your views on that? Are there any things that you really like as either as a user or perhaps as an investor? Would love to learn more from you with regards to this.
Yeah, so I'm a big angel investor in NFT Fi, which is like the market leader in NFT financialization, and they have like a really compelling Dune graph because like while NFT marketplace volumes are down like 95% from all time high, um, like NFT Fi's volumes are only down like 50%, and like my thesis on this is like NFT financialization is more anti-fragile than marketplaces because in a bull market people want to borrow against their NFTs for leverage, and in a bear market people want to borrow against their NFTs as like kind of a put option. Is like if the floor price crashes below their borrow amount, then at least they walk away with the amount they borrowed and default on their loan, which is essentially what a put option does. Um, so so which is why it's like more anti-fragile. It has like use cases in both bull and bear markets. That's what I really find compelling about NFT Fi. And also, as DeFi yields have come down and like become a lot more competitive, a lot of DeFi lenders have moved to like NFT lending. So like if you look at their June graphs, like monthly active lenders on NFT Fi like continues to reach all-time highs like each month, even though like we're in a bear market, and that's a really interesting metric to watch. Um, and what was your second other trend?
Web3 social and reputation layer and identity layer with verifiable credentials or soulbound tokens. So what's your
Yeah.
thought on that? Are you playing it through any instrument?
Yeah, so on Web3 social, so we invested in a Farcaster. Kind of my take on Web3 social is like token gated communities is going to be a really killer use case of Web3 social. And there have been a lot of projects that are like kind of only focused on like NFTs, like social. But I think it's better to take a broader approach, like more generalist approach, like Farcaster, where you start with a social network first and then add like token gated and like Web3 features down the road. Is like kind of what Twitter could do, but unless Elon Musk like leans into like Web3 and like adds all these features, um, like that's kind of the low hanging fruit that Farcaster is going after. And then the kind of like reputation identity. We talked about identity with ENS. Reputation. There's interesting projects like Sysmo and others that you can do like zero knowledge proofs and like attest that you meet some criteria. Say like you own like this NFT collection in your other wallet without having to like dox all of your different addresses. And I think that's a really cool feature is like being able to attest certain things without having to like dox your wallets. And like there's like protocols working on like these like reputation mechanisms.
You did mention you guys also run an NFT fund. So wanted to explore more on other use cases of NFT apart from PFP, like some of the verticals that you perhaps you guys invest in from a platform standpoint, or maybe perhaps from a individual collection standpoint that you feel are killer use cases for NFTs and kind of underappreciated by the market, apart from the identity ENS.
Yeah, so for the NFT fund, we own CryptoPunks. It's a kind of I'm much more bullish on CryptoPunks than Bored Apes because CryptoPunks is authentic and they really have the benefit of being first. And like it sounds like kind of stupid, but like that's like kind of how it works in art, in the traditional art world. It's like if you're first to a new movement, you get a lot of like credentials and respect as that way. And like it's Lindy. We own Nouns as like an authentic CC0 project. I remember when loot mania happened like in late 2021, and like people were going to say like loot was going to be like the next big like building block for like CC0 and all that. But that was also like where like authenticity matters. Is loot was like a lot of urine vibes. Well, a lot of like short-term traders were interested in like pumping and dumping, versus nouns, which is like a more thoughtful long-term community. So that's where we decided to get into nouns instead of loot, and that's really paid off. We own some OG like super rare one of one art. Um, I talked about generative art earlier, but I think another flight to safety in a bear market is to like one of one art, especially on like super rare and like the stuff like X copy minted in 2018. And this also goes back to like being first and Lindy effect. Is like you can't reverse time on the blockchain. When something was minted in 2018, it's always going to have the status of like being one of the first OG NFT artworks ever created on Ethereum, and that's why those pieces are still worth a lot today. And obviously, like always looking at new projects. Maybe there's like interesting stuff in gaming, other collections. Yeah, that's the stuff on the NFT fund. And then for the main venture fund, it would just be like kind of investing in like marketplaces, stuff like OpenSea, Super Rare, ENS Vision, Catalog, Sloika, MetaHood. It's trying to like pick the leading verticalized marketplace in each space. Because if you think like the total market cap of like NFT is going to grow significantly over the next 5-10 years, I think like each vertical is going to be a multi-billion-dollar business. It's like right now, like OpenSea is the only multi-billion-dollar business in NFTs. I think like art or like music will be like big enough by itself to support a multi-billion-dollar business, which is why we're really like leaning into that thesis.
Yeah, I want to dissect this further. So, in terms of a mental framework to identify blue chip individual NFTs, you did mention Lindy effect and community. So, apart from those two factors, are there any other factors that you use as a heuristic when identifying the next blue chip or identifying the good performer in coming years in terms of a blue chip NFT or NFT that has a potential to become a blue chip?
For like projects that are like artworks, kind of really understanding the artist and whether or not they like really lean into the Web3 ethos. And like we're seeing this actually right now is like there's a lot of artists who did like really big expensive drops back in like early 2021 that have like pretty much like rugged their community. It was a way for them to like make a couple million, and then they just like kind of went back to their old art business and like didn't really care about Web3. And like those NFTs are obviously down a lot. Um, so is yeah, understand like caring if the artist has like a good story background and understands Web3 and like wants to do something more meaningful with it. I think those are like the key ingredients for new up and coming artists that are minting stuff.
And talk about platform. You guys are heavily invested in different verticals of NFT marketplaces. So what's the criteria there? You mentioned MetaHood, you mentioned catalog. Like one is for music, one is for real estate. So what's the criteria there? How do you guys know that okay, these will be the bets that we can take and they can become one of the top marketplace either as a monopoly or a duopoly in their specific verticals? Is there a mental model there that you guys use for NFT marketplaces?
It's ultimately like talking to the team, and like this kind of goes back to back in 2018 when we were like looking at OpenSea versus Rarebits. Is like also like being first is like also kind of underrated. Is and also like does the team really are they really passionate and do they care about Web3? And you saw this with OpenSea when they were really like digging into all these Discord communities, versus those who kind of come from like the Web2 world and see like NFT marketplaces as like a super obvious idea and like want to like jump into the pool. And like those founders typically like wash out when like things get really tough in the bear market. So yeah, it's like kind of talking to the team, understanding their motivations, authenticity. Do they really understand like Web3 community, and do they have like a unique perspective on like their specific markets.
So out of all the NFT verticals you mentioned, maybe real estate, music, uh, one-on-one art, which one NFT vertical you feel like is very under the radar, very underrated by the market that you feel in next couple of years will do really, really well and you're very excited about?
I mean, music NFTs, like volumes are growing like slowly month over month in this bear market. Um, it's taken longer than I expected for music NFTs to really have like kind of a crypto art moment where like volumes explode. I think like my main concern about music NFTs is like the collector distribution, and like I have a Dune dashboard on this, but is like about like 20% of like music NFTs are owned by like three individuals. And when you have distributions like this, like it concerns me that it's like a forced narrative by like a couple influencers versus like an organic community. And that was like certainly different with a lot of other like projects in the early days. So if like music NFTs can get like broader buy-in, which like Sound XYZ is like doing a good job with having additions, I think that will create a more organic community rather than like a forced narrative.
You did mention using on-chain data to kind of have a macro overlook of market. How are some of the other ways investors can leverage on-chain data? And what are some of your favorite metrics, like across the board, that you basically track when you're doing these on-chain analysis?
Yeah, I mean, aside like from like the obvious metrics, like KPIs would be like monthly volume, like stuff like number of like mints. I say like underrated metrics, like collector distribution is one. Is like just like from seeing the pie chart, you can really get a gauge on the health of the community. If like a handful of whales own like a disproportionate amount of tokens of or NFTs, and like they basically decide, and it becomes like a forced narrative versus like a more grassroots organic community. I think that's a really interesting metric to track. Um, I also like for NFT marketplaces, it's really important to track like will filter out like wash trading, and like it's really stunning how like marketplaces like Looksrare, where like 98% of the volume is wash trading. It's like same with like X2Y2. It's like I think in the 70s something percent. Um, and like metrics can be pretty deceiving at first if you don't do like the wash trading filter, because there are a lot of like traders that are like creating a lot of volume for like airdrop farming and like things like that. So like if you got to like go deeper into Dune as an investor to kind of filter out like what are the organic usage and like what's usage just for the sake of like airdrop farming.
Was there a time where you guys use on-chain data to identify either a private investment or a public investment? And if there was, like how did you guys go about it?
Yeah, this was Super Rare is like one that came to mind. We invested in Super Rare in like mid 2020, and this was like around the time like DeFi summer was taking off. So like it was around the time where like I clearly remember it's like kind of laughable now, but like the DeFi degens were like kind of too cool for school for NFTs. It's like they kind of poo pooed it. It's like this is like some a liquid non fungible shit coin with like a picture on it when we could be trading all these like liquid tokens and like make a lot of money there. But if you look at the Super Rare Dune dashboard that I created at the time, like monthly volume was like growing like 50% month over month, and the y-axis was still really small. Like they were only doing like a couple hundred k in monthly volume. But as a VC investor, is like you don't really care about the absolute number on the y-axis. You care more about the growth rate, and obviously when you project out 50% month over month growth, like pretty quickly it gets to like something crazy, and like that's what happened during the NFT craze in early 2021 when Beeple did his big drop, and like suddenly like crypto art popped up on like mainstream media's radar. So that was like an investment we made at the right time, that we spotted an early trend with data and then made the investment before like things exploded.
Yeah, a few days ago, I looked at your like from Dune Analytics conference. I was going through that, and there were a couple of hot takes that you presented with, like
Yeah.
evidence-based on-chain data. One was with regards to NFT marketplaces being better than aggregators. In fact, marketplaces still being better than aggregators, and another one was NFT financial products better performing, doing better than, let's say, other stuff. Can you just touch upon those two hot takes and maybe kind of uh, tell our audience how does that on-chain data allow you to kind of present that thesis?
Yeah, so NFT financialization over marketplaces. I talked about it earlier, a little bit earlier in this podcast, but it's like NFT lending and borrowing is more anti-fragile through like bull and bear markets. Therefore, like the volumes are more consistent than like marketplaces that like do really well in bull markets, but then like volumes are down like 90% in a bear market. They basically track like NFT prices. And then like on aggregators versus like kind of going directly to the marketplace, that was like kind of a more controversial take. Um, but the data is just like surprising how um, like a vast majority of volume is still going directly through the underlying exchanges rather than aggregators. And like Dexes is a one example. Is like there are like 30 different dexes now that you could trade with like meaningful liquidity. Yet still like I think 75% of on-chain volume is going directly through dexes like Uniswap versus to aggregators like 1inch and Matcha. For NFT aggregators, I think the breakdown is about like 90-10. And then bridge aggregators, it's like even more. It's like in like the 90s to like single digits, like 90% to like hop and like directly through these bridges versus aggregators. So people like to like VCs like to invest in aggregators because you kind of index the space and don't really have to like do the hard work of trying to pick winners. But I think the value capture is still largely in the underlying protocols. So it is worth trying to do your research, trying to pick the market winner, because in the off chance that you're right, like you win really big, like how Uniswap and OpenSea were like the two best investments in crypto in like the last 4 or 5 years.
Talking about counterintuitive examples, what have been some of the counterintuitive lessons you have learned being in crypto and being a Web3 investor?
Yeah, there's a lot. One that comes to mind is kind of the Web 2, like Silicon Valley VC, like investor mental model. A lot of those like lessons like don't apply in Web 3. And I guess one example is in Web 3, like pedigree and resume like almost like matters like nothing. Is like Web 2, like if you went to Stanford, you worked at Google or Facebook, like and you decide to start a startup, like you'll get funded like immediately. And like I think the reason is because in Web 2, like companies are a lot more managerial and like operational intensive. Like if you're building a company like DoorDash, there's a lot of like ops people you have to hire, and you have to be good at like managing people, just kind of running the entire business. Versus like Web 3, it's a lot more of like a like open source hacker culture where the skill sets are like being good at building product and understanding your community, and like the company that you build and hire like engineers, it might be like 10-20 people max, so you're not really going to need a big skill set of like being how to be a good manager. And that's how like if you look historically, like who are the most successful founders in like Web 3 in like the last like several years, is like almost all of them did not have like a traditional Silicon Valley resume. Is like there are people like living in I don't know Finland or Estonia or I don't know Australia, like places where like they got really interested in the community and like they built a good product that people wanted, and they didn't work at Google or Facebook beforehand. And you also saw this lesson play out with like the Solana ecosystem. Is like a lot of VCs mistakenly, in my opinion, like looked at like all this talent going to Solana. It's like, look, like we have all these great devs like building on Solana, but I think there was a lot of good pedigree that went to Solana. And like now that like Alameda and like a lot of the stuff like washed out, that's disillusioned a lot of those founders to go back to their Web 2 jobs, especially like now AI is hot and they have a lot of optionality, and like those jobs are pretty high paying as well. Um, that's like one counterintuitive take that I've learned from VC investing.
Have you been thinking about convergence between AI and crypto in different forms? I've seen few projects out there. Is that one of the theses that you guys are exploring, or any project that you have come across that excites you?
Yeah, it's like combining the two biggest buzzwords, AI and crypto. We have made one investment, which is deep NFT value, which is like using AI machine learning to appraise NFT collections. Like they have it with CryptoPunks and Bored Apes. There's a lot of these like NFT appraisal projects. I've like played around with all of them. Deep NFT value has like by far the most accurate like predictions model. I think the bigger upside for that is like becoming like on-chain oracle for NFTs. It's like right now, Chainlink and like other oracles are just focused on like cryptocurrency prices, but like NFT pricing oracle is like it's a really hard problem to solve, and it's there's a lot of upside for like the project that can get it right.
Yeah, you have given me different themes, different verticals to look at. Now, one question I want to ask you is perhaps one investment you regret not making, and potentially the reason. Like why do you regret that investment?
Yeah, that would be Dune. It's like really ironic because I'm like Dune's number one user. But yeah, I passed on Dune 3 times. Um, and I just thought that it's a SaaS business model at the end of the day. And I just thought like the total addressable market of like how many people would pay to use a crypto SaaS product. I just like thought that market was like pretty small. Um, and yeah, turns out they've done well. So it's for like kind of these like market sizing and like business model questions. Like they're always tricky to get right because it's really hard to like kind of predict how big the market will be in like several years. And like the conventional wisdom is like if you're a SaaS business model, you can only be successful if you're selling to like Fortune 500 companies because they can pay like multi-million-dollar yearly contracts. But there's a lot of counterexamples where that's not the case, where you can have a very verticalized SaaS model and that's a really big business.
Yeah, I also want to explore some tokenomics question with you. One question is regarding token incentive. Does it make sense? Like you have seen different NFT marketplaces, you have seen different DeFi projects. Like, what's your take on token incentives? This is something which is very different in Web3 and which is encouraged. You have incentives in terms of yield farming. You also have airdrops. Do you think it makes sense to give out token incentive pre-product market fit, or do you think it will be more potent when a project kind of achieves a product market fit and then there is a switch that just turns on and gives more token incentive to kind of hold on to that market? So what's your take on that? What's your take in general with regards to token
Yeah,
incentives?
on token incentive, I compare it to it's growth hacking is like at the end of the day, and I compare it to like .com startups in like the late '90s where they raised like so much money from VCs and they're just kind of throwing it all at like internet banner ads before like the marketing industry got really smart about how do you measure like CAC over CLV, user retention, like how much value you're getting out of like your marketing spending. So like with token incentives, the problem with airdrops now is like airdrop farmers have gotten like super sophisticated where a disproportionate amount of airdrops are going to farmers. And I was so like Hop was really interesting where they were really the first project to like pay people to identify like Sybil airdrop farmers, and then you got a cut of that if you if you like found these Sybil attackers, and like I was one of the top like Sybil airdrop hunters. I open sourced my GitHub repo for that. But a crazy stat is about 1/3 of Hop's initial airdrop distribution would have gone to airdrop farmers, and I'm sure that number is higher for like other projects because farmers have gotten a lot more sophisticated about like not linking their wallets together, using centralized exchanges, and like trying to make their usage look as authentic as possible. So I'm sure the average percentage of like airdrops going to farmers is like much higher than 1/3 now for other projects. Um, so that's on airdrops. And then for like liquidity mining, I think it's a good like short-term growth hack. Is like if you want to bootstrap liquidity in AMM, you can have like a liquidity mining program, and that can like quickly get a lot of TVL. It's like a chicken egg problem. It's like without enough liquidity in AMM, it's like just like impossible to do a trade like swap without having massive slippage. So that's like a good use case for it. I don't recommend doing liquidity mining like forever or like cutting emissions over time, because there's a really good Dune blog post like where they go into like the empirical research behind this. But like user retention for liquidity mining is like pretty bad. And like if you look at like who are the most engaged wallets today for like an OG established project like Uniswap, is like a lot of those were like new wallets that weren't like involved in liquidity mining like years ago. It could be like people have like recycled into like new wallets, but it could also be that like Uniswap's attracted new users, and the liquidity mining program they did back in 2020 like didn't create like sticky engagement. So like overall, like liquidity mining is good for like bootstrapping liquidity in AMM, but it's not like a sustainable long-term growth hack.
Hypothetically, if you were a founder, would you do an airdrop? Or let's say if you do a airdrop, how would you structure it? If you don't do an airdrop, like what would you do? Maybe go down the other route. So
Yeah, I think the tricky thing about airdrop is uh, like to be sufficiently decentralized, you need to give your tokens like to a lot of addresses. And the fact is, like a lot of these DeFi projects, like just or just any project, like just don't have enough like users addresses to do like a meaningful airdrop. Otherwise, like those addresses are just going to be like massive whales in your protocol. So like one solution is like you could, if you do a token launch, you could like allocate it to a community treasury, which is like kind of punts the question of airdrops like down the road, and like they can put out a governance proposal down the road on like whether or not to retroactively um, reward early users if like the timing makes sense down the road. Um, that's like my thoughts on doing airdrops.
so what's your thought on proof of useful work or proof of physical work, as some of the VC calls it, where you have decentralized Uber, decentralized Airbnb, decentralized Deliveroo? Have you thought about that? Do you think we will be able to crack it with incentive structure and token structure? So yeah, so what's your take on that?
I mean, like kind of these decentralized physical marketplaces, it's more of like been like a meme and like a buzzwordy thing. Because like at the end of the day, like Uber, Airbnb, DoorDash, they're very like operational intensive businesses. And when the success of the company relies on operations, not technology, that's like kind of like Web3 doesn't really solve like the crux of the problem. Um, so I'm always like hesitant when I see like real world marketplaces try to get like copied on chain.
Makes sense. So we are heading into the last segment of the podcast where I'll ask you a few rapid fire questions. Uh, so at the moment, what's your biggest fear in crypto?
Well, top of mind is like regulation. Is like kind of that's looming question is like whether we'll see like a Dodd-Frank bill type bill, but for crypto in the wake of like SBF and FTX. And the unfortunate reality is like a lot of politicians like don't understand the difference between like centralized exchanges and DeFi. Is like they kind of lump it all together as like this cryptocurrency thing. Um, when like at the end of the day, like FTX's like failure is like they were a crypto exchange, but like the same thing could have happened if they were trading Beanie Babies or like any other asset. Is like if if you do corporate fraud, if you like cook the books, you commingle like users' assets, like it has nothing to do with like the underlying asset they're trading. And I just hope that like politicians like don't like throw the baby out with the bathwater. It's like there's like very few congressmen that understand this, like Tom Emmer, who understand that like it's not an indictment of the technology. It's like kind of a old school corporate fraud. So that's my biggest fear is like regulation could be really bad for crypto, and that'll affect like U.S. founders.
Yep, that's also one of my top fear. It also hampers the token designs. That's the thing I do. Uh, it limits the design space of how we can design tokens when it comes to securities regulation. Um, so yeah, that is also something that keeps me awake.
Yeah.
So Richard, if you had $1 billion, what would you do?
Assuming the $1 billion wasn't stolen customer money. Um, I mean, like SBF, yeah, I would like try to get into politics, influence politics. It's just like kind of the unfortunate reality of the world is like if you don't have lobbyists at the table in DC, you're just going to get bullied out by like other special interest industries. Maybe industries like kind of the traditional finance, like big banks that may see crypto as a threat and like want to kill it. And like you got to have like money to fight. So that's what I would be doing is like getting more into like policy.
What are some of the side projects you're working on at the moment?
So cryptoart.io has been a project I've worked on since I think I started Thanksgiving 2020. It's like an aggregator site that like if you're an artist, you can search up your profile and like it'll show up your artworks minted on like Nifty Gateway, Super Rare Foundation, all these marketplaces. And I like the artist leaderboard. It's like kind of like a coin market cap, CoinGecko, like top cryptocurrencies, but like that's for top artists. And you can see the total market cap of crypto or NFTs, like summed up across all the artists.
Yeah, I'm impressed. Running a fund, doing this, also have like being a top doing visit. So now one question I'm thinking of is what's your routine like? Maybe I can there's some pointers and lessons there for myself.
Well, lately it's been a lot of tennis. I'm like training for a tournament, but yeah, it sounds like a lot of stuff to do with like investing in like doing a lot of the data work plus like managing all these side projects, like stuff that I've built. I say the tricky part is just like maintenance. Is like I have this joke where like the golden law of Dune is like the moment you publish a dashboard, it's already outdated. And like I'm very fortunate that like for example the OpenSea data team, like they've been like Karina and Kanjin, they've been really helpful at like whenever OpenSea like publishes a new smart contract, they'll like tell me, hey, can you copy paste this like SQL query to like update your contracts? Sorry, update your queries on Dune. So like yeah, maintenance takes time, but I'm like grateful for the people who've like helped me with that.
What's your biggest pet peeve in crypto?
I actually tweeted this a few days ago, but I'm just like surprised that a lot of people are like very quick to forgive wrongdoing. And like for me, it's like if I find out like someone's done a lot of shady shit like in the past, like I just like will refuse to do business with them. And like that's saved me a lot of grief because like basically it's like the stuff I know, it's just like only the tip of the iceberg of like even like worse stuff that's like that I don't know about. And like a good example would be like, SBF is like I knew from the beginning that early FTX employees were like insider trading like token listings and like front running their customers and like made a lot of like millions of dollars from that. And like just like kind of this like shady unethical practice has like made me avoid like the FTX Alameda ecosystem like completely. Because like if I know this stuff, like what other stuff do I not know? And turns out they were stealing customer funds. So it's a pet peeve of mine, just like surprised that people will kind of sweep this under the rug because they want to, I guess they're greedy and they want to do business with SBF until like the fraud gets exposed and it comes crashing down.
So Richard, before we conclude the podcast, what is one of the questions, not even one, like what are some of the questions I should have asked you, but I didn't?
I think you covered all the bases. Yeah, these are all really good questions.
Thanks, Richard. It was a great pleasure to have you. It was a good conversation. I learned a lot about different facets of crypto that you guys are investing in. Thank you very much for coming to the Open Metaverse Podcast.
Great. Yeah, thanks for having me on.
This podcast is for information purposes only and should not be considered as financial advice. Any opinions provided in this podcast reflect the views of the speakers only.